Hey guys, Candlesticks here. Welcome back to another Weekend Trading Edge video. I'm excited to show you around the markets and share a few of the top trading ideas that are on my radar for the week ahead. I've also got some really cool trading lessons for you as well, as we're going to cover some powerful topics. We're going to look at harmonic patterns such as Ciphers and Gartleys. We're going to look at reading candlesticks, how to identify key levels of structure, Fibonacci, head and shoulders, anchored volume profile, psychological number, inside bars, multiple time frame analysis, my 4-step process to consistently analyze in the market, and a really powerful lesson, which is why you must trade what you see and not trade what you think. Whew, that's a lot. But guess what? It's here on YouTube, so you can pause it and you can rewatch it as many times as you like in order to get the information that you need from it. Now, before we hop in, do me a favor, hit that like button and show me some support. Also, subscribe if you haven't done so already. That way, whenever I produce new videos, like random midweek videos, it comes straight to your feed and you're not left out. All right? Let's hop in. So as we jump into this week, I want to start off by saying hats off to anyone that survived last week. We had a massive amount of movement in the market. We had a lot of whipsaw, meaning the market going one way, then another way. And again, that was due to the different monetary policy releases that we had. Now, if you're a little bit confused about the movement, similar to I was the day after specifically the FOMC made their announcement, check out the Trading Coach podcast episode I did. It's episode 1216 called FOMC Whipsaw, Fed Rate Cuts, Dot Plots, and Market Reaction. It kind of goes into the details about why exactly we saw the move that we did and what the market was reacting to. Our job now as technical trader is to take advantage of the next potential reactions or opportunities. And we have a few here on the pound dollar. So the pound dollar has just come off a beautiful cipher pattern completion. Hats off to you guys that took this one. We were waiting on this for a while. I'm here on the daily, X to A to B, B to C, and then a CD completion right up here. When I say a while, again, you can see that we identified this well in advance, right? Beginning of August, and we had to wait for a retest of the highs. We had to wait for a little correction, and then finally we got to move right back up to that D completion at the 786. And you can see that price did a fantastic job of rolling over right to first targets, and hopefully we may get the second targets, and I'll kind of bring that up a little bit later. Now, what we also have, and you see this a lot during periods of consolidation, is a potential secondary cipher setting up as well, of course, depending on how your eyes read the markets. And that's going to look something like this. Our previous C leg up is going to be our X to A. Our retracement down that I said people had to suffer through while waiting for this pattern to complete is going to be our A to B. This extension up, which completed the initial cipher, is going to be our B to C leg. And then if we come down to this 786 right here, that would give us a D completion for a bullish cipher. So that would be a move up. And of course, the completion zone is going to be from our 786 to our X leg. We had a good conversation about this in the live room. We had one of our traders was a little bit confused about the completion zone, and I was going to do a separate video for it, but I might as well talk about it now. Essentially, when I give this completion zone, it's similar to a kill zone, meaning this is the range of price in which we expect this pattern formation to complete. The very first point is going to be up here at our 786. The lowest point, right, so the invalidation point, if we go beyond this level, is going to be right here at a retest of the X leg. So that means anywhere that price comes in this zone is going to be valid. So different traders take patterns differently. Some enter aggressively with a limit order at the beginning of the zone. Some enter aggressively with a limit order in the middle of the zone. Some look for confluence. It could be an indicator confluence. It could be a specific price pattern. Some people just miss it because they're doing other stuff and they get back late, or they don't notice it until they see this Weekend Trading Edge video. Regardless, it doesn't matter how you approach it. That's going to be up to you, and you want to be consistent in how you do it, of course. But understand that as long as price is within this zone, this is still going to be a valid pattern. So invalid above the zone, invalid below the zone, valid within the zone. So that's one opportunity here on the pound dollar. The secondary opportunity is going to come before that cipher, and this is going to be a structure-based trade. Again, price has put in 3 very aggressive, very bearish days. Again, we had Bank of England interest rate and monetary policy and votes and all that stuff happen as well the day after our FOMC. And if I were to ask myself, Akil, where do you think price is likely to terminate at, so find its next level of support? There is a key level that stands out to me, and it is going to be these two candles right here. Now, why these two candles? Well, one, you can look at the wicks, and the wicks tell a very crucial part of the story. The wicks, meaning the skinny part to the downside, that's going to tell us that price action at one point pushed down to that level before retreating back up. So you can see we did it there on the red candle. We did it again on the green candle before price eventually pivoting to the upside. We actually did this before at a previous level as well. If we look left, because structure leaves clues, you're going to see that this is also the shoulder level of our back-to-back head and shoulders pattern. So again, just to draw more stuff on for you to make you confused. If we look back in the past here, we had a nice head and shoulders right here, with this being the neckline. I meant to say neckline of one, shoulder level of another. We came right after that to put in another head and shoulders, right down here, and this is the shoulder line. So this is also known as an ice zone. There's a video I did on ice zones. I'll link it in the description box below. But essentially, an ice zone is a period where price action has found support, bounced off of it, support has turned to resistance, and basically price has respected that level a few different times here. I guess we don't really have the resistance part here. So this would just be a multiple level of supports. Maybe not an ice zone, but something similar, but still go watch that video. It's a good one. Anyway, the point is price has proven to respect this level in the past, which means I would expect it to maybe not respect it, but at least have a think at this level in the future. Meaning that if price were to come down, this is the level where I think some of the bears would be taking targets. This would also be the level where new bulls would be interested, a perfect opportunity for a short-term counter trend trade. And I say short-term counter trend trade because there's nothing here on the pound dollar that says, I think this thing is going to go to the moon. There's also nothing here on the pound dollar that says, I think we're going to retreat all the way down. So what you're looking for in this situation is you're looking to get in, get a little bit of the reaction, and then get out and look for the next opportunity. While we're on the subject of consolidation and back-to-back patterns, Euro Yen has one as well. We're going to be on the hourly here. And you can see a few setting up. We have a small one and a big one, right? If we start our X leg right up here at the high, right, you're going to see that we have a nice clean swing high to swing low. We call that an impulse leg or an anchor leg. We want to take our Fibonacci retracement tool from the high of that move to the low of that move, and we want to see what Fibonacci level we retrace to. In this case, we come to the 618 Fibonacci retracement, which is going to put us on alert for a Gartley pattern. From our Gartley pattern, I want to take my Fibonacci extension now from that A leg to this move right here, which is our B leg, and back down, and I'm looking for a decompletion at this 127. So that's going to give me a pattern formation that looks something like this: X to A to B, B to C, and if we push up, it would be a decompletion right up here at the 127, and again, once again, retesting these previous highs. Now, if we look on the other side, we'll just, I'll delete this fib so we can kind of clean things up a little bit, but if we look at our X leg being down here, doop, boop, and we measure out our swing low to swing high this time, swing low to swing high up here, you're going to see, once again, we come to another 618. That puts us on alert for a Gartley pattern. I'm going to bring out my 127, same thing I did before, just upside down, inversely this time, and that's going to give me a potential X to A to B, B to C, and a CD pattern completion down here. So bracketing the market here, if we go up, we have a potential pattern as of now. If we go down, we have a potential pattern as of now. Two opportunities for you to pay attention to on the Euro Yen. So next we're heading over to the Euro New Zealand on the daily, and this is going to be an interesting one because depending on the time frame you're looking at, this may or may not give you a clear signal. So I want to start off by looking at price action and asking myself, what was the recent move? Well, the recent move was a bullish rally up that held at a previous level of structure resistance, right? So this was our previous new structure high. We created it, we retraced off of it, we came back to retest it, and so far we held. If you're familiar with the 4-step process that we follow in our trading, IPDE, you know that I identify a hold of structure. Because of that, I cannot predict a move higher yet. And I say yet because I want to look forward and ask myself the question, if we can break this level, and this will make more sense later with a simple or a classic pattern formation I'll show you, where could we go next? So what I want to do is I want to just look left and I want to see where is the next relevant level of structure. I can go to my weekly or just keep zooming out. We're going to go all the way back to December 2009. What was I doing in December 2009? No, 2009, I think, is when I would have realized that I was really, really bad. I was about to quit. And then I did my famous story about doing an A/B split test, understanding that it wasn't my strategy that was bad. It was me because I kept breaking my rules, and I made the decision to try to stop my trading mistakes. That's when I did it in 2010. So yeah, good year. Anyway, regardless, as I reminisce, the next level of structure that I see, right, again, remember this white line is the previous level of structure, so we're right at this level. The next level of structure that I see is going to be right in here, again, going back to this 2009 December highs. So we're going to snap back to reality and see that if we can violate this level, there is some room to the upside that we can travel to. Now I want to go down to my lower time frames and take a look at what's happening. Well, you can see that we came up on the 4-hour chart. We actually do have a higher high, higher close. And this goes back to what I said about perspective, depending on what you're looking at. But you can see we kind of just hugged this level. We did like a little double top action, but nothing really followed through with it. We're kind of just going sideways. And some of you are already pointing this out. But if we go one more time frame down, what does this look like? It looks like a sideways channel or like a high and tight flag, depending on your perspective. Regardless, what I would wait for here is to see if we can get that violation, see if we can break out of this range to the upside. Because if we do, then we'll have that higher high, higher close. And again, if I zoom down, you'll see that we have room to roam all the way to 203s and beyond. I think we're almost at 204s right there. So this could be a very nice long-term bullish trend continuation opportunity if we can break out of this range to the upside. And that's a big if. And that goes back to something I've always said, but haven't said here on the video in a while. As traders, remember, we want to be predictive with our analysis and reactive with our execution, meaning we want to do everything that I just did to predict if this, then that, if this, then that, if this, then that. But just because I make the prediction, I don't want to just buy it right now because I haven't gotten any proof. I want for the market to give me a signal that something is more likely to happen than not. Then I want to react to that with my entry. So it's always important that we have patience. A lot of us make predictions and then we try to trade it right away because we think that a prediction is all we need to do. Remember, that's only half the story. And if you don't wait for that signal, right, you're going to be in a very dangerous situation as a trader. Next up is going to be the Aussie New Zealand. And this is an interesting pair. Let's go back to our 4-step process of analyzing a market, right? If you look at our previous structure highs right here, our previous levels of resistance, you can see that we clearly ended with a higher high, higher close, a new structure high. So we identify a new structure high. That allows us to make the prediction that price is likely to go higher. Now, if you remember what I told you in the midweek video I did with the Euro-Yen trade I shared with you, the prediction part is a 3-part process. Not only do we want to ask ourselves which direction is price likely to go in, but if we're likely to go higher, then where are we likely to go higher to? And once again, to answer that question, we need to look left. Now, this one's going to be a little bit interesting. We'll have to do a little bit more analysis, right? Like I said in the video I just mentioned before, right? We want to start with broad strokes and then add details. So if I'm looking left, the first zone that appears to me is going to be from right here, the lows of these 2 wicks to the highs of this red candle right here. And I'm going to drag this to the left so we can get a visual on this, right? So we are currently testing the bottom of that level, but we want to ask ourselves, is there anywhere specific in that level that stands out amongst everything else. We could do all types of analysis there. I'm going to keep it short for video purposes. But one thing I'm going to do is this. I'm going to bring some volume in and see if there's any type of volume level that looks more important than the other. And you can see there's not a lot up here as I look left or look to the right-hand side of my chart. But you can see that we're really in a void right now, but things start to pick up a little bit around this 113 level right now. What else is important about this 113 level? Well, it's also a psychological number. So let's just kind of mark this on our chart right here for kind of future reference. Now, one last thing, when I go to my daily chart, when I look on my daily chart, I can see that we have an inside candle, right? So this is called an inside bar. This green bar, not only is it a doji, which means indecision, but it's a bar that completes, completely within the previous bar, which tells us it's a form of consolidation. Not only is it a form of consolidation, but we could look at the location of this bar and see that this inside bar clearly forms or completes in the upper third of the previous candle. So just like the pattern I showed you on the last pair, it means that when we go down to the lower time frame, we're going to see whatever type of consolidation looks something like this, which is typically going to be flag pattern-ish, which again is a good sign for a potential bullish move. So let's dig down to our lower time frames, our 4 hour, right? You can see kind of the consolidation right here. And let's go one more down to the hourly, because this is where we can get fancy with things. So we have this consolidation here. We know that consolidation leads to advanced pattern formations, and that's exactly what we have here as well. We take this swing low to swing high right here. You can see that we hit and passed the 618, once again putting us on Gartley alert. We can bring our 127 or a Fibonacci extension tool on and drag out a 127. That's going to give us our completion point, and we're going to have a potential advanced pattern formation that looks like this: X to A to B, B to C. And if we come down here, C to D, a very deep Gartley at a very previous, very important previous level of structure, this retracement right there. So not only do we have the potential bullish Gartley pattern, but if you're someone that is anticipating a breakout to the upside, this would be a built-in reason, excuse, however you want to tell it to yourself, to get involved. And what I mean by that is this. You have the regular pattern formation, which is going to give you a pretty nice risk reward. Let me just measure it on real quick to kind of see what it looks like. These deep patterns are going to give good risk rewards here. So we're going to have something that looks like this for the pattern formation. Always pick the wrong tool here. There we go. Long, right at the 127. Stops right below, initial targets right here at 3-2. So a nice 2-to-1 risk reward there. But if you're someone looking for the potential breakout, right, here's what you would want to do. You can hold on to the second half of your position. So, or even add one. You can do whatever the hell you want, right? It's up to you. But normally the second half of our position would be taken out at the 618. But you can hold on for a little bit of a bigger move, right, up near that 113 level we looked at. And if we take a Fibonacci extension, right, I'm going to delete some of this just to kind of make it clear. But if we take a Fibonacci extension from our X leg to our A leg, which would be the same as taking a Fibonacci extension from our last extension, our last swing low to swing high, you're going to see that we have that 127 lining right up at that 113 even handle. So a decent pattern play in its own right, but this is also one where if you're looking for a reason to get involved in that potential bullish breakout or trend continuation trade, this pattern works right into that analysis as well. Lastly, we're going to take a look at gold because everyone loves talking about gold. Gold has started to consolidate as well. Once again, as the market tries to figure out how the hell it wants to interpret the news that just came out from the FOMC. But what we could be putting in here on gold is a potential head and shoulders patterns, right? Head and shoulders are classic pattern formations. They come at the exhaustion point of trends, and gold has been bullishly trending for a while here. So we're about 3/4 the way done. I'll have to do my math later because I don't actually know how many parts there are. We can do that right now. But what we're looking at is a left shoulder right here, this consolidation period where we go sideways. This retracement is what's going to form our neckline. We have a short extension up, right? So not a very I don't want to say a positive extension, not an extension you would get excited about as a bullish trader, right? Where it's not a big one where you'd be like, oh my gosh, yeah, it's strong, we're going bullish. This is one where you're like, I don't know, right? We're going in our direction, but I'm not too confident in it. We then have a return to our neckline right here, our secondary point, and then what we're putting in right now would be the shoulder. What would validate the head and shoulders would be a violation of this neckline. So if I just count the points for my own personal benefit, 1, 2, 3, 4, 5, 6. So we're 4/6 of the way done working on step number 5. Anyway, if we are going to create a right shoulder here, this is probably the place where we're going to do it at right here. We're pretty much symmetrical with the previous left shoulder. Now, what this would mean is not necessarily a longer term reversal in the trend. That's going to be more fundamentally based in my opinion, but it could mean a little bit of relief where we see a little bit of a bearish retracement beforehand. So the problem with this, for me at least, if we do go lower, where are we likely to go lower to? Well, area 1 would be right here for me. Area 2 would actually be a little bit deeper around this area. So why it wouldn't be ideal for me is because with the head and shoulders pattern, I personally use a horizontal neckline. So my neckline takes the lowest point. I'm a believer in horizontal support and resistance. So I would need this white line violated in order to have a valid pattern, which would take us right down into my expected profit zone, so there's no meat on the bone for trading. However, if you are someone that's using a slanted neckline, right, because we're slanting upwards, that should give you a much closer or much sooner violation, which would offer opportunity to trade it either from here down to this zone or wait for even a violation, a pullback, and then a chance to trade it down to that one. Which is right, which is wrong. There is no right or wrong. Again, it's up to you as a trader. It's personal preference based on what you value. As always, my suggestion is that you value the same thing consistently. You don't kind of take the slanted one this time because it opens up more room, but next time you take the horizontal one because you like that better. That's called cheating, and that's how traders kind of cut their foot off and sabotage themselves. I don't know when you cut your foot off. I don't know the saying, but you guys get what I'm saying. So just make sure you're consistent with whatever you do. Speaking of consistency, make sure you're consistent with keeping up with my content, not just here on YouTube, but the Trading Coach podcast as well. An easy way to do that is 1, hitting that like button, and 2, make sure you subscribe or follow. That way YouTube and whatever podcast platform you're using knows that you like my stuff. It puts it in the algorithm. That way when I put out new stuff like random midweek videos, it gets sent to your feed and you don't miss them. So I appreciate the support. As always, leave any comments or questions below if you have them. And until next time, plan your trade, trade your plan. Take care.
I wanna be the best in the game, invest in my name, check no restraints, I'm obsessed with the pain, I ingest, I retain, assess and I change, possessed by the thought I'll be free one day from society's restraints, money, clout and fame, mud, disease, a plague, we all love to hate, have to play the game, have to make a name, all our insecurities are on display.